This video is on the method of accounting for operating leases for both the lessor and the lessee. And compared to capital lease accounting, operating leases are extremely simple. So let's take a look at some of the differences between the lessor and the lessee. In the case of the lessee, the leased asset is an asset that's on the balance sheet and is depreciated over the lessor's depreciation policy for assets. The lease is recorded, the rental payments are recorded as lease or rental revenue. Number 3, the non-refundable lease charges to the lessee are recognized as revenue but over the life of the lease, so they're amortized over the life of the lease. Any third-party expenses or lesser lease concessions, such as free rent for a period related to the lease, are amortized, again, over the life of the lease. Now let's take a look at the lessee. The leased asset is recognized as rental expense in the period of the lease. And this also includes the executory expenses that are associated with that leased asset if they're paid by the lessee. Leasehold improvements, which are generally related to the leased property, should be deferred and written off over the economic life of the improvements or at the end of the lease, whichever of the two is shorter. Non-refundable lease charges are recognized as an expense, again, over the life of the lease. Any third-party expenses related to the expenses are amortized over the life of the lease as an increase in monthly rent expense. Lease concessions such as free rent are amortized over the life of the lease as a reduction of monthly rent expense. Now, with that information, we're going to go over 3 multiple choice questions. Fashion Inc. leases and operates a retail store, and the following information relates to the operating lease for the year ended December 31st, year 4. The store lease, which is an operating lease, calls for a base monthly rent of $1,500 due the first day of each month. The additional rent is computed. This is done by many malls and shopping centers. The additional rent is computed at 6% of net sales over $300,000 up to $600,000 and 5% of net sales over $600,000 per calendar year. Net sales for the year, in this case, were $900,000 for Fashion Inc. Now, the company paid executory cost to the lessor for property taxes of $12,000 and insurance of $5,000. So the question is, for year number 4, what are Fashion's expenses relating to the store lease? In other words, rent expense. So again, stop the video and when you're ready, restart it to view the answer. Okay, number 1. The question again is, for year 4, Fashion's expenses relating to the store lease were, and in this case the answer would be B, $68,000. And we can list these by our year 4 minimum lease payments were $1,500 a month times 12 months. That equals $18,000. Additional rent that we have to pay based upon that surcharge is going to be between $300,000 and $600,000. We're going to have to pay 6% of our rent. So that's 6% times that $300,000, $300,000 to $600,000 gap, $18,000. Any additional rent over $600,000, there's a surcharge of 5%. So it would be 5% times $300,000 because our total rent was $900,000. So the additional rent over the $600,000 would have been $15,000. Our executory costs were included, $17,000. So our total rent expense is going to be $68,000. Okay, let's take a look now at question number 2. As an inducement to enter a lease, a lessor grants a lessee 9 months of free rent under a 5-year operating lease. The lease is effective on July the 1st, year 3, and provides for monthly rent payments of $1,000 to begin on April 1st of year 4. In the lessee's income statement for the year ended as of June 30th, year 4, rent expense should be reported as. Again, stop your video, and when you're ready for the answers, restart the video. Okay, the answer to number 2. In the lessee's income statement for the year ended June 30th, year 4, rent expense should be reported as, in this case, would be A, $10,200. Now, our rent expense for operating leases should be recognized on a straight line basis unless there's a compelling reason for another systematic or rational allocation basis. Now, in our case, this was a 60-month rental period, and when we look at the amount of rent that we're going to have to pay, we're going to actually have to pay rent for 51 months. So it'll be 51 months of rent times $1,000 monthly payment. So our total rental payments over the 5 years will be $51,000. So we take the $51,000 of total payment, we divide that though by the 60-month term, so our effective, basically our monthly rent expense is going to be $850. If we take our $850 monthly rent expense, we multiply it times on an annual basis of 12 months, it is going to be $10,200. Okay, let's take a look at the answer to number 2. And the question again is, in the lessee's income statement for the year ended June the 30th, year 4, rent expense should be reported as, and the answer would be $10,200, which would be A. Now, rent expense for an operating lease is typically recognized on a straight line basis, unless there's some other systematic or rational basis that would be more appropriate. Now here's how we do the calculation. First of all, this is a 5-year lease, meaning that it is actually a 60-month lease. And we're going to pay rent for actually 51 months, which is 60 months less a 9-month worth of free rent. So we're going to take 51 months of rent times $1,000. That means the total rental contract is going to be for $51,000. So we take the $51,000 of total payments over the life of the contract, we divide it by the 60 months of the rental contract, which means that we're going to have an $850 monthly rent expense every month. If we take the $850 monthly rent expense and multiply it times 12 months, we come up with $10,200 annual rent as our rent expense. Now, some students get confused. They go, well, wait a minute. You say in the lessee's income statement for the year ended June 30th, year 4. Yes, that is for the year ended June 30th, year 4. And if we go back to when the lease was signed, it was effective on July 1st, year 3. So that was a full year, because apparently this company ends its fiscal year on June 30th, year 4. Let's try question number 3. Okay, question number 3 is, on January the 1st of year 4, Company A leased a building to Company B under an operating lease for 10 years at $50,000 per year, payable the first day of each lease year. Company A paid $15,000 to a real estate broker for a finder's fee. Now, the building's depreciated at $12,000 a year. For year 4, Company A incurred insurance. Company A, who basically is leasing the building, incurred insurance and property tax expenses totaling $9,000. Company A's net rental income should be, again, stop your video, and when you're ready, you can restart the video. Okay, the answer to number 3. Again, the question is basically, what is Company A's net rental income for year 4? And the answer in this case is A, $27,500. We take our yearly lease revenue of $50,000. From that, then, we subtract out our broker fee. But this broker fee basically is for the is $15,000, but that's for the term of the lease. So we take the $15,000 broker fee, divide it by the 10-year lease, and we amortize that broker fee at $1,500 a year for 10 years. So we have a $1,500 broker fee amortization, we have $12,000 of depreciation, and we have $9,000 worth of property tax expense. So our net rental income in this case would be $27,500. And that is the end of the video. The next suggested video would be leases, and it's an extremely short video on disclosure. So thank you for your time.